Welcome back everyone, it's Stack and Save, and look, let's be real, market crashes are scary. When the numbers plunge and everyone's freaking out, it's easy to want to pull your money out and hide it under the mattress. But here's the thing, market crashes are also huge opportunities. While most people are panicking, the savvy investors, they're buying. But not just any stocks, they're buying strategically, focusing on companies with rock-solid fundamentals that can weather any storm. In this video, I'm going to show you exactly how to do that. We're talking about the best stocks to buy during a downturn, the kind of companies that not only survive but thrive when times get tough. From recession-proof giants that everyone relies on to tech titans sitting on mountains of cash, we're breaking down the stocks with the highest resilience and the biggest long-term upside potential. Stay with me to the end. I'll even reveal one overlooked sector that most investors are sleeping on right now. Trust me, you don't want to miss this. Let's kick things off with a sector that might seem boring but is anything but when a recession hits, consumer staples. We're talking about the companies that make the stuff you use every single day, no matter what the economy is doing. Think toothpaste, shampoo, laundry detergent, toilet paper, the essentials. Even in a recession, people still need to brush their teeth, wash their hair, and, well, you get the picture. This means demand for these products stays relatively stable even when people are cutting back in other areas. They might hold off on that new car or that fancy vacation, but they're not going to stop buying toilet paper. That's why investing in consumer staples can be such a smart move during a downturn. These companies provide a level of stability and consistency that's hard to find elsewhere. And when it comes to specific stocks in this space, two names immediately come to mind: Procter & Gamble and Coca-Cola. Procter & Gamble, ticker symbol PG, is like the king of consumer staples. They own a massive portfolio of iconic brands like Tide, Crest, Gillette, Pampers, you name it, they probably make it. This gives them incredible global reach and a diversified revenue stream. Plus, they're known for their efficient operations and strong cash flow, which is exactly what you want to see in a recession. Then there's Coca-Cola, ticker symbol KO. I mean, come on, it's Coca-Cola. This company has been around for over a century and their brand recognition is second to none. They're a dividend-paying machine, consistently returning cash to shareholders year after year. And here's a fun fact for you. During the 2008 financial crisis, while the S&P 500 plunged over 50%, Coca-Cola's stock only dropped around 25%. That's the power of a truly recession-resistant business. So when the market takes a nosedive, remember the essential nature of consumer staples. These companies provide the products people need day in and day out, making them a potentially solid investment during uncertain times. Let's move on to another sector that tends to hold up well during recessions: utilities. Now, I know what you're thinking, utilities? That's even more boring than consumer staples. And yeah, you're right. They're not exactly the sexiest companies out there. But when it comes to weathering a market storm, boring can be beautiful. Think about it, everyone needs power, water, and gas, regardless of what's happening in the economy. People might cut back on eating out or buying new clothes, but they're not going to suddenly stop turning on the lights or taking showers. This makes utilities incredibly resilient to economic downturns. Now, within the utilities sector, there are a couple of key players I want to highlight. First up, we have NextEra Energy, ticker symbol NE. NextEra is a leader in renewable energy with a massive portfolio of wind and solar assets. As the world transitions to cleaner energy sources, NextEra is well positioned to benefit. Plus, they have a strong track record of dividend growth, which is always a plus in my book. Then there's Duke Energy, ticker symbol Duke. Duke is another major player in the utilities space, known for its consistent returns and reliable dividend. They're a bit more traditional than NextEra, but they're a solid operator with a wide moat. And here's a bonus for you. Many utilities, including NextEra and Duke, pay strong dividends. This can provide a nice cushion for your portfolio during a downturn, as those dividend payments can help offset any losses in your stock holdings. So, when you're looking for stability and income in a volatile market, don't overlook the utilities sector. These companies might not be the most exciting, but they provide essential services that people rely on, making them a potentially solid investment during uncertain times. Now, I know what you're thinking. You're talking about buying stocks during a crash and you're recommending tech? Listen, I get it. Tech has a reputation for being volatile, especially high-growth, unprofitable tech. But here's the thing. Not all tech is created equal. Just like in any sector, there are companies with rock-solid fundamentals and companies that are built on hype and speculation. During a market crash, you want to focus on the former. The tech titans that are sitting on mountains of cash, generating consistent profits and dominating their respective markets. And when it comes to these tech titans, two names immediately come to mind: Apple and Microsoft. Apple, ticker symbol AAPL, needs no introduction. They're the most valuable company in the world, with a brand that's synonymous with quality and innovation. But beyond the brand, Apple is a cash-generating machine. They have over $100 billion in cash on hand, a loyal customer base, and a knack for creating products that people can't live without. Plus, they're constantly buying back their own stock, which is a great way to return value to shareholders. Then there's Microsoft, ticker symbol MSFT. Microsoft has undergone a massive transformation under CEO Satya Nadella, shifting their focus to cloud computing with Azure. And let me tell you, that bet has paid off big time. Azure is now one of the leading cloud platforms in the world, generating billions of dollars in revenue for Microsoft. Plus, Microsoft has a dominant position in enterprise software with products like Office and Windows. These aren't speculative bets, people. These are cash cows with massive moats and incredible long-term growth potential. So, don't be afraid to dip your toes into the tech sector during a downturn. Just make sure you're focusing on the established players with proven track records and strong balance sheets. Alright, let's move on to another sector that tends to be relatively recession-proof: healthcare. Now, I'm not talking about flashy biotech startups or experimental drug developers. Those can be risky even in the best of times. I'm talking about the established healthcare giants, the companies that provide essential products and services that people need regardless of the economic climate. Think about it. People get sick, need surgery, and require ongoing medical care whether the economy is booming or busting. This makes healthcare spending relatively inelastic, meaning it doesn't fluctuate as much as other sectors during economic downturns. And within the healthcare space, there are a couple of companies that stand out to me. First up, we have Johnson & Johnson, ticker symbol J&J. J&J is a diversified healthcare conglomerate with businesses in pharmaceuticals, medical devices, and consumer health products. This diversification gives them a level of stability that's hard to find in the healthcare space. Plus, they have a long history of dividend growth, making them a favorite among income investors. Then there's Pfizer, ticker symbol PFE. Pfizer is one of the largest pharmaceutical companies in the world, known for its blockbuster drugs like Lipitor and Viagra. They've also been a major player in the COVID-19 vaccine rollout, which has boosted their revenue and earnings. And here's a bonus. The aging population is a major tailwind for the healthcare sector. As people live longer, they tend to require more medical care, which translates into increased demand for healthcare products and services. So when you're looking for a sector that can weather an economic storm, healthcare is definitely worth considering. Alright, let's wrap things up with a sector that might surprise you: discount retail and essentials. Now you might be thinking, people cut back on spending during recessions. Why would I invest in retail? And you're right, people do cut back on discretionary spending during tough times. They might hold off on that new TV or that fancy vacation. But here's the thing. They still need to buy essentials. They still need groceries, household goods, and other everyday items. And when money is tight, people tend to trade down to cheaper options. This is where discount retailers and essential retailers come in. These companies offer lower prices on the products people need, making them more attractive during economic downturns. And when it comes to specific companies in this space, two names immediately come to mind: Walmart and Costco. Walmart, ticker symbol WMT, is the undisputed king of discount retail. They have stores all over the world offering incredibly low prices on a vast selection of products, and their size and scale give them tremendous bargaining power with suppliers, allowing them to keep prices low even when inflation is rising. Then there's Costco, ticker symbol COST. Costco operates on a membership model, which means their customers pay an annual fee to shop at their stores. This creates a loyal customer base that's willing to spend money at Costco even when times are tough. Plus, Costco is known for its bulk discounts, which can be a major draw for budget-conscious consumers. And here's a fun fact for you. Both Walmart and Costco outperformed the S&P 500 during the 2008 financial crisis and the 2020 COVID-19 crash. That's right, these companies actually went up while the market was tanking. So when you're looking for recession-resistant stocks, Don't overlook discount retail and essentials. Look, I'm not going to sugarcoat it. Market crashes are stressful. It's never fun to see your portfolio drop in value, even if you're invested in solid companies. But here's the thing. Market crashes are a normal part of the economic cycle. They happen, and they will happen again. The key is to be prepared. By investing in companies with strong fundamentals, consistent track records, and the ability to weather economic storms, you can position yourself to not only survive a market crash but potentially thrive in it. Remember, the best investors aren't the ones who try to time the market perfectly. They're the ones who stay disciplined, stick to their long-term plan, and use downturns as opportunities to buy great companies at discounted prices. Now, I want to hear from you. What stocks are you buying during this downturn? Let me know in the comments below. And don't forget to subscribe for more weekly deep dives into investing, personal finance, and building real wealth, especially when it's hard. If you found value in this video, hit that like button and share it with a friend who could use some investing inspiration. Stay tuned for our next video, you won't want to miss it.